Welcome back, dear viewers, to another fiery edition of Boss Economics World, where we take a wrecking ball to the economic mess-ups festering in your government's backyard. Today, we're going to dive right into the chaotic quagmire unfolding between President Trump, the Federal Reserve, and a mountain of questionable economic decisions that practically beg for a spotlight. Buckle up, because we're not just here to talk your ear off, we're going to break this down point by point so that both you finance pros and all you regular folks out there can see how policy misfires lay the groundwork for recessions. Our talking point today: Trump's recent flip-flop on interest rate cuts. The president, in a rare moment of moderation, actually agreed with the Fed's decision to pause rate cuts for the time being. Surprised? Don't be. It's no mystery that Trump's economic strategies have been a tad contradictory. Let's recap. The Federal Open Market Committee, FOMC, decided last week to keep the federal funds rate in a range between 4.25% and 4.5%. They hit the pause button, which seems like a good move on the surface. We'll explain why, in light of rising inflation. But peel back the layers, and you'll see how this whole situation is a prime example of cumulative policy blunders coming home to roost. And who's being left holding the bag? You, the everyday citizen trying to afford groceries and keep your job while inflation swings at you like a left hook. Ever since Trump stepped into the Oval Office, he's sung two very different tunes on monetary policy, calling for lower interest rates every chance he got, particularly when the economy seemed to be softening, like during his address at the World Economic Forum in Davos. But wait, suddenly now he's all for keeping rates stable. What gives? Well, while Trump may want to take credit for the decision's strategic brilliance, the economic signals flashing around those rate hikes are far more complex than many realize, and to be completely honest, questionable policy choices over the past few years may have worsened the situation. Let's walk through this, step by step. Rates standing pat at 4.25%. 4.5% has a lot to do with bubbling inflationary fears, but don't get too comfortable. The Fed's hands have been tied in no small part by Trump's very own economic policies, and now they're playing damage control. Tariffs. Deportation sweeps. These measures haven't exactly been smooth sailing for the economy, to put it politely. Inflation is not some random freak occurrence, oftentimes, it's the direct result of specific government actions. Enter Trump's barrage of tariffs. Remember, the Trump administration slapped tariffs on everything from steel and aluminum to electronic parts from China, raising the prices of imported goods. What's the economic principle behind this? Higher import prices mean higher consumer prices, which stokes inflation. So, while the president heralds these tariffs as ways to boost American manufacturing, or at least he says that's the goal, your weekly grocery bill has been steadily inching upward. Tensions with China added fuel to the fire, stoking fears across industries that rely heavily on global supply chains. Case in point: the tech industry, where a significant portion of components come directly from China. The scale of this inflationary risk is clear in the U.S. inflation rate tracker. 2019 inflation rate, hovering at 2.3%, pushing higher after tariff announcements. By the end of 2020, it surged above 3%, an alarming figure for an economy that was already feeling the pinch. Let's not forget that Trump also cranked up deportation sweeps, which undermined industries reliant on immigrant labor. Economic disruption much? You bet. His economic nationalism philosophy, a misguided one, has consequences. Immigrant workers, especially in the agricultural sector, represent a substantial share of the labor market. Remove them through deportation without stabilizing that labor supply, and you run into worker shortages, which increases costs for businesses. That extra cost passed on to the consumer. More inflation. What's worse is it's not just consumer products like your morning coffee and imported electronics. Housing and healthcare costs have skyrocketed too. Inflation impacts the necessities, the basics that Americans simply cannot live without. Now, it's not like the Federal Reserve is blind to these issues. They've been trying to manage the economy in real time, using interest rate changes like a scalpel, instead of Trump's infamous sledgehammer. Here's the trick question that plagued them: lower rates like Trump wanted or keep them paused to curb inflationary overheating? Many of Trump's die-hard supporters thought lower interest rates would stimulate more economic growth during soft patches. The theory here is relatively simple: if interest rates are lower, borrowing becomes cheaper, both for businesses and individuals. More borrowing leads to more spending, and more spending leads to growth. Right? Not so fast. Lowering rates too much creates dangerous bubbles. Remember the 2008 financial crisis? One of the contributing factors was artificially low interest rates leading to reckless borrowing and a housing market bubble. Now, I'm not saying Trump is entirely responsible for this risk, but his constant pushing for lower rates was borderline reckless given the state of the economy at the time. The pre-pandemic economy already had pockets of frothiness, especially in stock markets artificially inflated by low rates. The S&P 500's consistent climb throughout Trump's presidency reflected more speculative trading and less in line with the fundamentals of all companies. Let me put this as clearly as possible, America's dependence on easy money led by near-zero interest rates is a ticking time bomb. We might not see it explode today, but those prolonged low rates are eventually unsustainable and could trigger the next recession. The Fed chose to keep the rates in the 4.25%–4.5% range in their most recent decision. And here's why. They're trying to prevent an all-out inflationary spiral, similar to the stagflation nightmare of the 1970s. Back then, we had weak growth and persistently high prices, a toxic mix. Trump's policies could have unwittingly laid the seeds for a mini version of that mess. Now, experts still debate whether a 1970s-style stagflation is on the horizon, but there's no denying the similarities, even if they're less dramatic. For everyday Americans, it feels like they're paying more for everything, even though their wages have stagnated. This leads us to the next major problem with Trump's economic strategy, his persistent fixation on economic nationalism. While the rhetoric of America First may sound strong on the campaign trail, it falters under rigorous economic analysis. Economies today are globalized, despite Trump's best efforts to decouple the US from the world market. Here's the thing our workforce and consumers need to wrap their heads around: a globalized economy produces cheaper goods and higher efficiencies due to interconnected supply chains. Disrupt that, and you face massive inefficiencies and unexpected costs. Sound familiar? Yep, these policies weren't just about targeting China, they were creating collateral damage. Manufacturing is a key talking point in this debate. But guess what? Despite the tariffs and nationalist policies, U.S. manufacturing as a share of GDP has been hovering at historical lows, around 11% in recent years. What's worse is that any marginal benefit to sectors like steel didn't trickle down in any meaningful, long-term way to boost domestic employment. Remember, over 85% of manufacturing job losses since 2000 haven't been from outsourcing but from technological automation. Tariffs completely missed the mark in this context, focusing on squeezing others abroad instead of fostering innovation at home. To wrap it all up, but keep your eyes on the ball because this saga won't end soon, what we have here is a tangled web of incoherent policymaking that's going to cost the American people dearly. Inflation will remain a hot issue for quite some time. Tariffs, labor shortages, and rising costs in crucial industries aren't just fleeting issues. By the end of 2024, we could see inflation surge again past 4%, well above the Fed's target of 2% inflation. Recessionary warning signs are there. Raise rates too quickly or mishandle the pandemic's fragile recovery. The result might be a sharp economic downturn rather than a soft landing, which could throw millions more out of work. As of the start of 2024, upward of 40% of economists surveyed by the National Association for Business Economics believed a recession was either ongoing or just around the corner. Global confidence in U.S. markets continues to decline, as inconsistent trade practices, looming debt figures that cross the $35 trillion mark, and out-of-control defense spending leave foreign investors skittish. Trump's economic double dealings could leave us badly positioned for 2025 onwards, as we navigate recession risks, domestic discontent, and international uncertainty. The government's failure to coordinate consistent fiscal strategy with smart, foresight monetary moves is what really has economists fired up. Because, by focusing on short-term political wins, they're sacrificing long-term stability. The U.S. economy remains a fragile beast. What we have under Trump's leadership is sharp policy swings. One hand is slapping tariffs down while the other is calling for rate cuts that Federal Reserve economists know could just temporarily mask the failures of longer-term policies. We'll keep a close eye on this situation here at Boss Economics World, and you should too. Stay woke to these complex policy decisions, folks, because if our leaders don't get their act together, it's you who ends up footing the bill for their economic blunders. And don't let them fool you, economic boom stories are all fun and games until the bill comes due, and it's getting ready to slam down hard. We'll see you next time with more in-your-face truth-telling, dissecting the economy before it dissects your wallet.